Okay, in this video, we're going to be looking at how to calculate, or rehashing how to calculate inflation, and then looking at some of the problems with inflation and what causes inflation. So look at these figures, just a bit of a recap. You've got the September 2016 figure, the June 2016 figure, and the September 2015 figure. If you want to calculate annual inflation, you will do this year's figure minus last year's figure divided by last year's figure times by 100, which will give you the annual figure. And if you want to get the quarterly figure, you would do this year minus the last quarter, which is June, divided by the last quarter times by 100. So it will look like this. 110.4 minus 109.2 divided by 109.2 will give you your quarterly figure. And if you divide it by last year's September quarter, you will get the annual figure. What this annual figure represents that during the year, prices have increased by 3.66%, but over the last 3 months, prices have only increased by about 1.1%. That's what those figures mean. So if you look at this table here, this tells you a lot of information. This is from the Australian Bureau of Statistics. You can see how much prices have increased in the different categories. So this figure here tells you what the average price increase was for the CPI, which is 1.8%. So an average price have increased by 1.8% for the year and 0.6% for the December quarter. So they went up by about 0.6% in the last 3 months, but over the whole year, they went up by 1.8%. And then within that, you can get an idea of what changes in price have occurred. So alcohol and tobacco prices have increased by 6.5% for the year, and that's because the government continues to tax tobacco, so the price continues to go up and up and up. And then other things, communication has gone down by 3.8%, so it's becoming cheaper to communicate. But most other categories have experienced increases in prices, some small and then some not so small. But overall, the biggest increase has been alcohol and tobacco and the biggest decrease in communication. These other two figures here are just different ways to calculate inflation, which we won't get into at this point in time. So again, how much has inflation increased? Another question, it's not 24%, it's 134 minus 110 divided by 110. Another question, if the CPI increases from 107 to 109, does that mean inflation increased by 2%? No, it doesn't. Increased by 109 minus 107 divided by 107, so you'll find out it increased by about 1.87%. What it actually means is that prices were 9% higher in in September 2017 than they were in the base year, but in June they were only 7% higher. So that tells you the quarterly inflation figure. Another question, it says over 2014 the transport category within the consumer price index fell by 1.9%. Provide a possible explanation for this and why it did not lead to deflation. So there's two things you need to do there. One, basically over the second half, fuel prices may have fallen, so transport will generally go down if petrol's cheaper because it becomes cheaper to, there's an oversupply of oil, or it becomes cheaper to run your cars. And the fact it doesn't cause the CPI to fall because the transport category is only one of 11 categories within the CPI. So the other categories may have increased by enough to mitigate or to be higher than the decrease in price in transport. So the decrease in price in transport was not significant enough to mean that overall on average prices went down. And that's partly because transport's got a relatively low weighting, but also because it's only just one of 11 categories. Okay. In terms of problems with inflation, so there's issues associated with high levels of inflation. There's other issues, but these are the main four. So one, consumers experience a drop in their purchasing power. So when inflation increases, people have less purchasing power to buy goods and services, and that's because prices are expensive. It generally hurts what we call fixed income earners more. So people that are like pensioners and people on unemployment benefits, they generally suffer the most because they find it hardest to increase their wages. Whereas people in jobs like, say, ambulance officers might find it easier to increase their wage in line with inflation because they've got more bargaining power to increase their wages. So it generally hurts those that don't have jobs or less bargaining power more. Second problem with inflation is Australian firms become less internationally competitive. So if our prices are going up too fast, Australians might choose to buy imported products more, and countries overseas may not want to buy our products or our exports either. So we become less internationally competitive. Firms might lose confidence in sales and invest less. So when inflation's high, firms become pessimistic about their ability to sell because they're less competitive, and that might lead to less sales. And lastly, the RBA will generally increase interest rates to try and control inflation, which is bad for people with mortgages because then they have to pay more interest on their mortgages. So there's sort of the four main problems with prices going up too fast. Less internationally competitive, people lose purchasing power, firms lose confidence, and interest rates increase. Last thing I want to discuss in this video is some factors that cause inflation. So there's essentially two causes of inflation. There's demand inflation, when higher prices are caused by increases in demand in the economy, which means that demand goes up and we may not have the resources to supply enough to meet that demand, so firms will increase their prices. And cost inflation, where firms experience higher costs of production and may have to increase their prices because it's costing them more to produce goods and services. So they're your two main types of inflation. So demand pull inflation looks a bit like this. I know we haven't studied these graphs in a lot of detail in our classes, but basically this is our supply potential. And basically if aggregate demand increases by too much or total demand increases by too much, we can't supply enough to meet that demand. So firms are forced to raise prices to try and compensate so they don't run out of stock. Cost inflation is occurring when prices increase cost of production. Don't worry too much about these graphs. We'll talk about these in class. So basically, demand inflation is caused by an increase in the components of aggregate demand, so consumption, investment, government spending, or exports. It can occur when there's lots of confidence in the economy, or when unemployment's really low because people have got lots of money, or interest rates are low, so people are spending more. And basically, it's caused by an increase in aggregate demand in the economy. Whereas cost push inflation is caused by increased costs of production, so it might be increased wages, reduced productivity from firms, anything that increases their cost of production. It might be higher oil prices, higher transportation costs, anything that will lead to higher costs to produce goods and services. So to finish, here's some examples of things that might cause demand inflation and cost inflation. So demand inflation might be caused by higher consumer confidence. When people are confident, they generally spend more, and that leads to more inflation. Lower income taxes, when there's lower tax rates, people generally spend more because they've got more disposable income. Higher disposable income, so people have just got more money from their job, which might be because they're getting paid more, because taxes are lower. Lower interest rates, people will spend more because they're paying less off their house, so they've got more money to spend, and they're more willing to go into debt. Stronger overseas growth will generally increase the demand for our exports, which might lead to higher prices for Australian products as well. And it also means more jobs for Australians, which may then lead to more consumption spending as well. And a depreciation of the dollar, because then our products become more competitive and there might be more demand, so that leads to higher prices as well because foreigners buy more of our products. In terms of cost push inflation, anything that increases firms' cost of production. So higher oil prices, higher wages, because oil is used for transportation and manufacturing in production. Higher wages, higher prices for raw materials. When the dollar depreciates, it also causes cost push inflation because it costs us more to buy parts from overseas. So it can be like if we're buying, say, an engine to build a car, it may be more costly to import the engine, and as a result of that, they may have to increase their prices. And weaker productivity, it costs us more if we're generating less output per unit input. So if our workers are less productive, it's going to cost us more to produce goods and services. Thanks.